This is a special edition of Macro Voices with hedge fund manager Eric Townsend, the premier financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. Now, for this special edition of Macro Voices, here's hedge fund manager Eric Townsend.
Macro Voices All-Stars episode 74 was recorded on October 28th, 2019. I'm Eric Townsend. All-star Brent Johnson, founder of Santiago Gold Fund, is back with us today. This episode of Macro Voices is brought to you by TopTradersUnplugged.com, which happens to be my favorite podcast when it comes to quant and rules-based investing. Check them out. You'll be glad you did. Brent, it's great to have you back. I've really been looking forward to you. Now, for the benefit of any newer listeners, Brent is the guy in the face of all of the experts that we've had on saying, okay, look, the economy's really bad. We got a lot of problems. This means the stock market's been going down. Brent was the guy to say, they're right about the economy. We got a lot of problems, but the stock market's not going down. It's likely to move substantially higher. Why don't you explain, Brent, this morning the S&P, as we're speaking, is breaking out to new all-time highs, despite the fact that there is a lot of bad economic news. How were you able to see this coming, and what do you forecast? What do you see on the horizon?
Well, yeah, thanks again for having me, Eric. Happy to be here and talk to you guys. Essentially, I've had this theory for the last couple of years that the global economy is slowing. And that means, a lot of uncertainty for global markets and where will people go as a result. Now, as an individual, you can just sell everything and go sit on the sidelines and you don't even have to play the game, so to speak. But big pools of capital, the big asset allocators, they don't really have that as a choice. So when I was viewing the world and doing my analysis, a year, 2 years ago, trying to figure out where are people going to go, they don't have the option to just go sit in cash. So then where are they going to go? And, you've got interest rates at all-time low and sometimes negative. You've got emerging markets that have been under pressure. You've got the U.S., who has on a relative basis done pretty well and had done several rate hikes, 9 rate hikes over a 2-year, 3-year period. And I just thought that we would remain, when I say we, the United States would remain on a relative basis better than the rest of the world, even though that we would slow, and even though the economy in the U.S. might not improve and that the rest of the world, or the world in general, might come under a lot of pressure. I thought that the U.S. dollar, and as a result, U.S. dollar assets would benefit from that. And I think that's what we've seen. I think that capital still has to go someplace. And I think on a relative basis, the U.S. looks pretty good. Now, we've slowed here in the last, call it 6 to 9 months. We had a big pull down last fall. And then we've had a big rally, the first half of the year, and then we've just kind of gone sideways for the last 3 or 4 months. But now we're kind of breaking out a little bit here in the last week. I think it's a result of a relative trade relative to the rest of the world. And I think we're going to see that continue to play out over the next couple of years. Now, I should say that I am somewhat cautious here over the next 2 months. I think it's very possible that we have a repeat of last year, maybe not to that extent, but something similar where we have a big drawdown at some point in Q4. But if that does happen, I will be buying aggressively into it because I think the stock market still has a lot higher to go over the next year or two. When I say the stock market, I mean the U.S. stock market.
Speaking of the next few months, we've got some really big monetary policy things on the horizon. Mario Draghi is leaving the ECB and being replaced by Christine Lagarde, who takes the helm in just a couple of days here. The Halloween handover, as some people are calling it. That's happening. And at the same time, the Fed also has a meeting where they are widely expected to possibly cut interest rates. That also has an impact. How do these various central bank actions play into your thesis?
Yeah, that's a very good point. And I know a lot of people have been really focused on the Fed meeting this week, and rightly so. And I can talk about why that is. But I think fewer people are paying attention to Christine Lagarde. And this is just my opinion, but I don't think Christine Lagarde wants to play second fiddle to anybody. And I think she's going to come out guns blazing in November. I mean, I don't think it's going to be mid-December or January before we hear from Christine Lagarde. Now, that doesn't mean that she's going to come out, Thursday or Friday morning on her first day and make some big grand announcement. but I don't think we're going to go more than a couple weeks without seeing her center stage. And I don't know what she's going to announce, but I don't think she's going to be, just kind of sitting over in the corner quietly looking at her notes. I think she's going to come out with some big, bold plan. And, I think that will have some effects on markets. Now, at the same time, we've got Fed this week, and they're going to have to explain their introduction of this standing repo facility. And I think it's important to kind of address that, what it is and what it isn't. Now, there's this big debate, is what they're doing QE? They say it isn't. A lot of people say they are. I mean, listen, it's QE. I mean, you can dress it up however you want, but it's QE. Now, it is not the same as the QE that they were doing before. So I have a little problem with the people who say it's not QE, but I also have a little bit of a problem with the people who say it's the same as it was before. It's no different. I mean, it's very different, but at the end of the day, they are still providing liquidity to the market. But what I think is very interesting is they're not, and this is, I talk to a lot of people who say that the U.S. is, going to default, or, they're going to have trouble funding the government. Listen, they've had no trouble funding the government, and I'll debate anybody on that. The Treasury auctions that we've seen ever since this repo facility has been rolled out have been strong. They were strong prior to that. We've come nowhere near to failed auctions. In fact, a lot of the auctions since this repo facility has been rolled out have been more subscribed by foreign buyers than domestic buyers. So the idea that nobody wants to buy a treasury, I think, is just wrong. And I think you see that in the relative rates. If the treasury was having trouble funding, you would see the treasury yield rise. What's rising is the repo yield. The repo yield is the trade between banks. So, it's JP Morgan or Chase or whoever it is not wanting to lend money to Bank of America or Deutsche Bank or Credit Suisse or whoever it is, and that's, to me, that's understandable. There's big problems in the global banking system, and the whole world needs dollars, not just U.S. banks. Foreign banks need dollars almost as bad, maybe perhaps worse than U.S. banks. So when one bank doesn't want to loan dollars overnight to another bank, and in order to do that, they want to get paid a lot more. That's the demand for dollars showing up in the repo market. I mean, if you could loan to the Fed and get 2%, why would you loan to Bank of America and get 2.5? I mean, you would in a normal circumstance, but if there's a demand for dollars and you're not sure you're going to get those dollars back, it's safer to park them at the Fed. So it's the interbank market that's freezing up. It's not the Treasury market, but the Treasury market does have a big impact. When I was up in Vancouver with you at the beginning of the year, I put a chart up that showed when the Treasury comes back in and starts issuing debt again, that is going to put pressure on the dollar, and they're going to be sucking up all the dollars that everybody else needs. And that's what we saw when Treasury started issuing bonds again in August and September. That big issuance, they went in and sucked all the dollars out of the market, and it left less dollars for everybody else. That started to put pressure on the dollar. You saw the dollar jump up to 99.50, 99.60, something like that. And they had to come back out and, put this facility in place to provide liquidity to the market. But what I think people need to understand is QE, that is proof that there is demand for dollars. If nobody wanted the dollars and everybody was getting rid of the dollars, there would be no reason for the Fed to provide more of them. So, QE is back, but it's not the same as the previous QE.
Let's move on to gold. Now, for the benefit of any new listeners, you and I are both extremely bullish on gold on the very long term. But we've both expressed the view that, hey, we really moved up a lot real quickly. Seems like there should be a significant pullback before the market goes higher, or at least that's what technical analysis teaches us. What are your current thoughts on that, Brent? Because I was completely, or have been completely in agreement with you. But boy, it's taken longer than I thought to see a really significant pullback develop. What were you expecting, and how long do you think it's going to take? And at what point do you throw in the towel and just say, hey, we're going to consolidate sideways and move higher?
Yeah, so, you and I have been pretty much on the same page on that. And when you say throw in the towel, I mean, you and I, we've both owned gold for a long time, right? So if it turns out that the gold bull market adheres and it runs higher, I already own gold. Yeah, I didn't get the first part of it right between, what was it, 1275 and 1550. I was not expecting that big run. It didn't surprise me when it went to 1350. Well, it did surprise me when it broke through like the 1375 and had the run to 1575. But, since then we've had about $100 pullback or $80 pullback, whatever it is. I still think that we're going to pull back to that breakout zone at least. I think we're going to at least go back to the 1400 level. That doesn't mean it's going to happen right now. It wouldn't shock me at all with everything that's going on over the next 2 months. With the Fed policy and the ECB and what's going on in Hong Kong and China and Spain and you've got all this civil unrest all over the world. Wouldn't surprise me at all if we got one more little pop in gold back to 1530, 1550. But I think ultimately we've got to go back and retest that 1400 level before we go higher. Does it happen in the next 2 months? I'm not sure. Maybe it happens in 2020. I still think it will happen. But again, if I'm wrong, so be it.
And finally, Brent, any other thoughts that you'd like to share with the audience before we close today?
I think one thing I would say is for those who've followed my milkshake theory for a year, 2 years now, I've always said that the U.S. is going to be the last to fall, and I still fully believe that. And it's not because I think that we have the better policies and the better people and the better country and we're the greatest place in the world. I just think on a relative basis, and because of the way the monetary system is designed, that we're going to be the last to fall. Listen, that does not mean that we're not going to take a few punches along the way. To think that we're going to go through this, just on a nice, easy upward trajectory, and it's all going to be sunshine and roses, I think it would be extremely naive. I think there's going to be points in time where, we take some pretty hard knocks, but ultimately, I think the rest of the world's going to take the knocks even harder, and that they will ultimately fall in some kind of a domino effect, and it'll eventually come to the U.S. But I still believe that over the next 2 to 3 years, we're going to be the place to be.
Well, Brent, I can't thank you enough for a fantastic interview. We look forward to getting you back next month for another update. Listeners, be sure to stay tuned. We got Danielle DiMartino Booth coming up this week, as well as Alex Gurevich on the feature interview for our Thursday night podcast. This episode was made possible by TopTradersUnplugged.com, my favorite podcast when it comes to quant and rules-based investing. And remember to head over and listen to my conversation with its host, Niels Kastrup-Larsen, which we released on September 7th, 2019. To get the slide deck that Niels shared, head over to TopTradersUnplugged.com/macro slides, and as a listener of my show, you're also able to get a free copy of Niels' latest book just by going to TopTradersUnplugged.com/macro. For the Macro Voices Podcast Network, I'm Eric Townsend.
That concludes this edition of Macro Voices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. Please register your free account at macrovoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to Macro Voices on iTunes to have Macro Voices automatically delivered to your mobile device each week free of charge. Macro Voices is presented for informational and entertainment purposes only. The information presented on Macro Voices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Macro Voices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. Macro Voices, its producers, sponsors, and hosts, Eric Townsend, shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on Macro Voices.